Okay, so today I want to discuss a commonly misunderstood topic, net working capital. If you're like me, you learned this in school and they taught you that it was current assets minus current liabilities. And I think that's one of the greatest misconceptions within finance. So we're going to talk about what net working capital actually is, as opposed to what you find when you Google it or what your professors might have taught you. What it really is, it's the cash tied up in the daily operation of your business. So let's say, for example, you want to open a shoe store. Well, what would you need to buy if you did that? Well, to open a shoe store, of course, you can need shoes to sell. So the first thing you have to do is buy inventory. But if you're buying inventory, let's say you have pretty good credit. It's not your first rodeo. You might not want to pay immediately with cash. In fact, you probably want to pay with credit. So if you buy that inventory on credit, that's going to affect your accounts payable. And then finally, you buy all your shoes and your first customer walks in and they might pay on credit. Well, if they pay on credit, that's accounts receivable. So you kind of see how net working capital is really just driven by the daily operation of your business, such as a shoe store. So let's go through the first example. If you buy $100 of inventory with cash, well, how does that affect the three statements? Nothing happens in the income statement because you haven't sold the inventory yet. So with matching principle, the idea is that you can only recognize expenses when the product or service is delivered. So we can't recognize that as COGS, cost of goods sold, nothing's been sold. But on the cash flow statement, we have an outflow of cash of $100 here because we're going to buy the inventory in this example with cash. And so that goes under cash from operations. So your cash from operations is down 100, your cash is down 100. On the balance sheet, your inventory is up 100, and those cancel out and your assets are zero. And so you got your shoes and your cash is down. But previously I said you could also buy the inventory on credit, meaning that would affect accounts payable. So the only difference here is you can see that your inventory is still an outflow of $100 buying that inventory, but here we're going to have an inflow of $100 on accounts payable. So that represents you buying it on credit, and your cash does not change in that case. It's $0. So inventory still goes up by 100, but now you have a liability accounts payable of 100, which you have to pay back eventually. Okay. So let's say you sell your first pair of shoes for $200 and with a tax rate of 20%. That means that you can recognize our revenue. So you're going to make $200 of revenue. And because you're selling the product, meaning you're delivering the product to the customer, you can now recognize the cost of goods sold as an expense. So that's $100 because you paid $100 for the inventory previously. So that means that your pre-tax income is $100, 200 minus 100. And with a 20% tax rate, your tax is $20. So your net income will be $80. And on the cash flow statement, we're going to start with net income because we're going to bridge net income to cash. And here, there's actually two ways to do the net working capital. My preferred way is to actually think about what happens on the balance sheet first, because it's pretty intuitive. For example, if you sell a pair of shoes for $200 on credit, that means your accounts receivable is going to be up 200 on the balance sheet because your client owes you $200. So that's an asset. You're going to expect that $200 later. Meanwhile, if you sell a pair of shoes, well, you're down a pair of shoes. Your inventory is going to go down by $100 because that's what you paid for that pair of shoes. So once we know what happens in the balance sheet, we know what happens with the cash flow statement, because think about it this way. If somebody owes you money, right? They owe you $200. Is that good or bad for cash? Well, it's bad because you'd rather have received that instead of them owing you. So it's an outflow of cash. So you can see that accounts receivable is down 200 here, outflow of cash of 200 on the cash flow statement. Meanwhile, if you sell inventory, right, your inventory goes down. Well, what happens to your cash then? Well, then you would have more cash. So your inventory is up 100 on this side. So that's one way to think about it. The other way to think about it, right? So I'm going to go into this a bit more, by the way, but the other way to think about it is what are the non-cash items on the income statement, right? Think of the cash flow statement as this sort of statement of truth where you say, whatever happened in the income statement was not necessarily a cash item. And because I'm trying to get from net income to the change in cash, I'm going to reverse any non-cash items. So on the revenue up 200, well, did you actually receive $200 of cash? You did not, right? It was on credit. So we're going to reverse that 200 here on accounts receivable, negative 200. And meanwhile, the COGS here, right, down to 100. Well, when the sale was made, did you take $100 out of your pocket and hand it to some entity or, no, all you did was give the customer a pair of shoes. You had actually bought that inventory previously. So, so because of that, this is also a non-cash item. We're going to reverse that negative 100 in the income statement here with inventory plus 100. So either method works. Whatever is more comfortable for you. And then finally, to finish off the balance sheet here, you can see that the cash down by 20 links up here to the balance sheet. You can kind of see that it all links, right? It all kind of flows. The last item, it goes to the first item. The last item, the cash statement goes to the first item of the balance sheet. And then we kind of talked about the net working capital here, and shareholders' equity is the final one. That's up 80 because it's connected directly to net income. The net income flows to the shareholders. So now on the topic of like, well, sometimes folks ask me, well, why does cash go down if the asset goes up? Think about it this way. Let's call this the golden rule of net working capital. If asset goes up, cash, which is another asset, has to go down for the balance sheet to balance. But this also makes sense because think of it as like buying an asset. If you buy an asset, like you buy inventory, you buy shoes, your assets go up, you have more inventory, you have more shoes, your cash goes down because you had to pay for it. The other way is true as well. If you sell an asset, your asset will go down and you will receive cash for that asset. So cash is a way to finance that asset. The other way to think about the liabilities is if the liability goes up, cash goes up because it's like borrowing money. If you borrow money, your liability goes up. You owe that money now, but you also receive cash, so your cash goes up. And the other way is true. If you pay back a loan, that liability will go down. You owe less now, and your cash will go down because you just paid for it. Okay, so now to tie it all together. So we can think of net working capital as being operating current assets minus operating current liabilities. So if net working capital goes up, then cash is going to go down because that is cash being tied up in the operation of the business. So for example, if this part, the operating current assets goes up, cash goes down, and we said it's sort of like buying assets in a way. Meanwhile, we're going to subtract the operating current liabilities. So if those, if those increase, in other words, those liabilities go down, then your cash goes down. So basically, if net working capital goes up, cash goes down. If we think of the liabilities going down as being like we're paying down liabilities, or paying down things that we owe, for example, like for example, debt or accounts payable. If net working capital goes down, cash goes up. The other way is true. So they're kind of just inverse because then your assets would be going down, for example, and your cash going up. Kind of like when you sell an asset, or if your liabilities go up, your cash also goes up. Kind of like if you borrowed money. So some businesses actually have a decrease in net working capital as they go on. So it's a source of cash. And that, for example, we're going to talk more about this later, but a customer might pay upfront for a service not yet received, like for software subscription companies. So they actually receive cash upfront. And that's going to be a topic for next time. We're going to talk about deferred revenue and how that works. So to conclude it all, what is net working capital? What is not net working capital? Well, hopefully by now you've understood that it's perhaps is not always true what you learn at school or go online, because we don't want to include things like cash, right? So let's talk about what is net working capital first. It's going to be things like accounts receivable, like the example we gave, selling and credit, inventory. You have to have products to sell if you're in a product business. Prepaid expenses. I didn't talk about this, but like let's say you pay upfront 2 years for rent, right? So you're paying that money up front. That's an asset because it's going to get expensed over time. Matching principle says you only expense it when you actually receive the service. So it becomes an asset until you receive that service. We'll go through another example on that in later. Other current assets is sort of just a bucket. It could be any sort of random things. So the key thing is you do not want to include long-term assets. Okay, so if it says other non-current assets, you don't want to include that into your net working capital, and nor do you want to include tax items. These are tax things that are not part of your daily operations, right? That's related to the way tax is calculated. It's not a core operational item. On the liability side, accounts payable is very common. If you're buying inventory, for example, so you might pay for that on credit. Now, there's also accrued liabilities. A lot of people ask me, well, what's the difference between accounts payable and accrued liabilities? The difference is that accounts payable has an invoice attached to it. So when I go buy those shoes, they're going to give me an invoice, say, hey, you bought this inventory. you owe us this much. But accrued liabilities is more like, for example, unpaid wages or unpaid rent or unpaid vacation. Um, there's no invoice. It's not like your employee is going to be like, hey, I've worked here for 8 days and you haven't paid me because you pay me once every 2 weeks. Here's the invoice for how much you owe me for the 8 days I worked. They're not going to do that. They know you're going to pay them eventually. But for accounting purposes, we still have to recognize those unpaid wages and unpaid vacation time, or for example, unpaid rent. Those are things that we owe, but there's no invoice attached. So that goes accrued liabilities. Deferred revenue, we're going to talk about more, but and go through examples. In fact, we'll go through examples for accrued liabilities as well. But for deferred revenue, think of this as businesses where customers actually pay you upfront for a service you have not yet delivered. So an example of that might be your like the software subscription business. Let's say you're Microsoft Office 365 and somebody pays you for a full year. You haven't actually given them anything yet. So you have to recognize that as a liability, as a service that you owe, and only when you've given them the service after a year has passed and they've gotten the benefits of using, Microsoft Excel and Word and that kind of thing, then you can recognize the revenue and the liability will disappear. And finally, you have other current liabilities, which once again is just a bucket of other things. But you would not want to include other non-current liabilities because a long-term liability. You would not want to include anything that's debt, right? Because if you're paying interest for a loan, that's not actually part of your operations. That's a financing decision that you made to borrow money and then pay for that service through interest expense. Accounts payable, on the other hand, for example, there's no interest on it. So it's just part of the vendor trying to win your business by giving you a little more time to pay. So it's part of your daily operations. Tax items similarly would not be net working capital. And so that is basically a wrap on that. And next up, we're going to talk about some of the items we didn't cover yet. So the deferred revenue, prepaid expenses, accrued liabilities.